4:15. Kess, you there?
Yes, sir. Right here, loud and clear.
Sup? Nice to finally talk to you, Kess.
Yeah, right. It's
I,
been what? Never since the last
yeah,
time
I
we
know.
talked in person.
I don't think even ever. Yeah, yeah. Kess picked the world's best week to go to the beach for the market.
Yeah, from what it looks like, it seems that way.
Yeah, yeah. So what we did last time, Kess, with Zach, was basically just tell us a little bit about Kess, and then we'll kind of just get started on just what we think in the market, and then just whatever random stuff we want to talk about.
Sure. What's up, everybody? I'm Kess from KessInvesting. I'm a 20-year-old stock Twitter guru. I do college part time and Twitter on the side. I started trading back in April of 2020. Back when the COVID crash happened, and fell in love instantly, basically, with it. The idea of working for yourself and being able to spoil yourself and be your own boss and stuff like that was very appetizing to me at the time. So that's kind of how I started off, and ever since then, I've grown this account and this community that I've started to build around the Stampede and with John and Zach and all the guys that I interact with on Twitter. We've made this community something pretty special so far. So I'm pretty excited for the future of everything, and I'm excited for this talk today.
Yeah, that was a great intro, Kess.
I was
Very
practicing.
professional. Yeah, but what you said there about like with Kess being so young and just getting started out, and even I'm 27, but I started like 5 years ago in the stock market, but not really doing option trading until like the last 2-3 years. But I think what's important to remember is that so many people are like new to investing now that if we do enter into a bear market here and rates start raising and things start changing, I don't think any of us really have a reference point for how to react in
No,
it.
absolutely not. Yeah,
Yeah.
especially with when I started, everything was all euphoric and everything just went straight up. So it'll
Yeah.
definitely be challenging to kind of adapt to a new environment.
Yeah, and that's what happened. Like with me, I started slowing down into Thursday because you guys started seeing like an extra rate hike getting talked about, and more taper. So if things start changing, we're gonna be in won't be just constant uppies no more. It'll be a little bit of selling the rip. The dips might not keep continuation. There's a couple names that had that big bounce, but then didn't keep going forward like we're used to. But again, it could just be the overreaction to start, but never good when the Fed start talking about raising rates. So
No,
what I yeah,
absolutely.
I think what's it called? Did you see that thing from Zero Hedge today, Kess, where they said 2024 they're talking about 2.5% is what they wanted rates to be.
I think I saw somebody retweet it. I don't follow Zero Hedge, but I see it usually in passing, some of his tweets. But yeah, the 2% is what they're aiming for 2024. I heard.
Yeah, so I know you like Snap better. You still on Snap? Or are you gonna walk away from growth? What are you thinking for growth?
Growth is in a tough spot right now. There's a lot of being down names that are below 50% from their all-time highs, and it seems appetizing to kind of jump in now. But what you have to kind of remember is, with the past year and a half, 2 years, with this euphoric run, some of these growth stocks just might be a little overvalued. Like you can't really say, what the actual price valuation of it should be, if everything ran in the past 2 years at an unprecedented rate. So instead of catching falling knives and stuff like that and going full positions at these stocks and growth stocks that are at their sub 50% and 50% from all-time highs, you kind of want to. I'm waiting personally to see some sort of support and basing and people start to step in, like bigger names start to step in, institutional holdings and stuff like that to step in. So there's no point in risking, entering too early, especially with growth stocks, because with growth stocks, there is tons of time, hence the name growth. You have
Yeah,
time for
exactly.
that stock to grow. So the last thing you want to do is get caught catching a falling knife with a stock that will end up, finding some sort of support eventually and reverse to, a new high. It might not be a new all-time high, but it might be a newer high where it'll find, a new range. So
Yeah, and another place to even think about is this: you have a bunch of money that you want to put into something right now, it might be even a better idea to look at more established tech stocks, or just like, I know everyone's talking about PayPal constantly, but some of these more established companies that have that long term support, like Kess is saying, like some of these growth stocks like Snapchat and Pinterest, they went straight up, and just as fast as they can go up, they can go right back down. Like I think Pins was what, wasn't it down to like $8 before its crazy run up, or
Yeah.
something ridiculously low. So those, like, why you might see like, hey, this stock's way down from all time highs. You got to look back to, hey, where was that first active support where buyers stepped in to start the run back up? Because if rates go up, it gets harder to borrow money, which makes it harder to grow, and then hence grow stocks. So that's what you don't want to be necessarily the first one in line, and it's not even terrible to be the last one in line when the run starts, when you're looking at these long-term investments. But with the weekly options trading and even the monthlies, I think people ask me today about swings. I think right now it's a better idea just to kind of see how things shake out these next couple. Like, I'm not going to be taking any big aggressive swings on anything. I know like Pinterest is in the 30s and Snapchat is down to, I think it was 40. Did it go into the 30s today, Kess? Do you know? I
No,
think it
I
was,
have no idea. I could check real quick.
yeah, I think it
I
was,
have a feeling it did.
yeah, here, I'll pull up it. 'Cause I saw things were real low. It,
Almost 41. It hit 41 in pre-market, but never
yeah,
got below 41 today.
and then I'll just go back and look. Yeah, so like in 2019, when Snap was going down before growth started running, Snapchat was down under $6. So just to give you some perspective on how far these things can really go down. So you don't want to be going in heavy. It might be worth it to take, maybe like start building a small position in leaps in these growth stocks, because you get that same exposure with less capital required. And if it doesn't go your way, you can kind of walk out. Same thing with comments. You could set your own resistance or support levels you want. And then if it breaks above or falls below, just kind of walk in and walk out as necessary. But I think if we continue to work down, like if we had a couple more weeks like this where growth just got beat down for a few more weeks, I think that's where you really start to get some really attractive opportunities with the Snapchats, the UPSTs, Palantir, stuff like that starts to get really appetizing.
Yeah, no, I totally agree. And what you said about, as quickly these things come down, you said how Snap was like in that $6 mark. It was in that $6 mark, and they had that range, for years, basically, for not years, but a lot of months, where it was, bouncing between like this $20 and $4 range until it broke out to like hitting the all-time high of 84 or 83. You have to think about it like that, as you have to see some sort of like basing and time and opportunity to get in. And you will be rewarded with growth stocks over time. You just can't expect it to reverse as quick as it fell, in order to catch the right move. You have to wait to see some sort of basing, support, anything, a new floor made, some volume shelves, made, anything really to kind of justify you going long in that position for a long-term hold.
Yeah, right. Yeah, and that goes back to the whole thing where when you're taking those you got to have your plan going in. Like when you buy those weeklies, like I might buy them to say like, hey, I want to capture this move, and I might get it all today, and I might get some of it like the rest of the week. So, but that's only like a 2 or 3 day period. When you're going in and like starting to dip your toes into buying these stocks to hold, you got to be taking like a multi-year view, not just multi-month. Like if you're saying, I think by 2030, like all this stuff will be worth X amount. Like if you think Snapchat will be in the hundreds in the next 5 years, like obviously you want to start walking your way in the 40s. But if you think, hey, it might make it back to 80, it might not be worth it for you to start putting that capital in there quite yet. And you really got to see how the Fed starts to, if they really maintain these rate increases. I think the first one's scheduled in March. So we're probably going to see I don't think we're going to see a bunch of continued upward momentum. Like, I don't think we're going to break 500 in SPY if there's these rates looming. I think we might see a new all-time high maybe on a recovery, but I think it's going to be pretty hard to push through that level with those rates looming. But if the March Fed meeting comes and goes without any rate increases and they start to be dovish again, I think that's where you can see like a return of money into those growth stocks. And there were um, money flowing into like Snapchat leaps and stuff today. So you can see the institutions still trying to position themselves a little bit just to see if they're going in or going out. But you got to remember, $3 million to an institution might be like $100 to you. Like you don't know what their capital is that they plan on putting in. Like I know I saw this Snowflake sweeper go in with $10 million every time Snowflake went down. He just kept rolling $10 million back in and in and in. But you don't really know what his strategy is. All it is they say, hey, this is kind of a good start to start building a position. So there is some interest in these growth stocks now, but I think it's a little bit. I wouldn't consider it the bottom quite yet.
No, especially with the inflation concerns and like you said the rates. There's going to be a little more time to kind of play out and feel out what's the right move in the future, to kind of go from there.
Yeah, it hurts my soul, Kess. I always gig a bull, but I'm not quite bear, but I'm cautious bull now.
Yeah, I know. When I saw your tweet responding to the guy asking for swings and you said cash, that was a couple. That raised some red flags to me. There was some alerts going on in my brain. We're in trouble now.
Yeah, and that's just from like if you this is like a great time where if you have older friends or like older family members or anyone who's been in the market for like I don't know 10 or 20 years who've really done it their whole life, this is a great time to kind of ask them like, hey, how did you react during like a bear market or if when there was like stock market crashes or how did you kind of weather the storm? And they might not know the answer, but they might be able to at least tell you their experiences about it because we're a lot of us and a lot of my followers, a lot of Kess's followers, pretty much a lot of Twitter in general is just pretty new to the stock market, and we've been used to just a bull market the whole time without having to worry about. It was always rates every time rates went down for the past year and a half, 2 years, stocks just keep going up, but it's the inverted. Rates go up, stocks go down, and then eventually you'll kind of meet that equilibrium where stocks can continue up and it's not going to take the whole way to 2024 like they said, but it might be another like 2022 might be a consolidation year or like a slightly downtrend year as money starts shifting from growth into something else where they kind of start moving back into banks. So I'm not ready to start betting in one place or the other, but I'm actively observing where things are going to shake out.
No, yeah, I agree. And what you have to kind of remember too is some of these growth stocks that have had these huge runs, weren't even IPO'd during bear markets, so we don't even know how, from historical price, we don't even know how they'll react to it. So you only really kind of take the judgment from the stocks that have reacted to these bear markets and stuff like that, and look at historical price for that. Like Snap was IPO'd I think like in 2017 or something like that, or 2018, and it hasn't really experienced much of a bear market, but if we enter a bear market, we don't know how it'll react. Growth stocks can turn into penny stocks, for all we know. So you kind of have to take it day by day and adapt with what's happening and all the changes that are, thrown at you. And, just prepare for the worst and hope for the best, honestly.
Yeah, and one thing I'm curious to see that happens in the next few weeks is what happens to all the meme stocks. Because if money really starts flowing out and people really start panicking about things, how's like today? Like GME falling the whole way down. What it was up 30% pre-market, or 30% after hours, and like 20% pre-market to close only up 4%. It almost went red. Not red, but fell through low a day and then curved back up. So I think I don't know. Market makers and the market likes to repeat patterns. So last January, the market pushed, and then so did the meme stocks. And then on the 6th, with the Capitol riot stuff, DWC rallied yesterday. So it's one of those things where are we going to Groundhog's Day and repeat everything that happened last year? Like, when did Bitcoin was selling off and cryptos were selling off too, and then we had that summer was it this when did crypto sell off last year? I'll pull up the chart real quick. Yeah, so end of January is where crypto started going up after being down a little bit. So it's one of those things where maybe maybe they just flip the disc back over and we play it all, we just run it back. But it it's never good when stocks and cryptos are going down at the same time. Usually one's going up or one's going the other. Like they were talking about rates going up, so that could be pushing it down. What do you think about that, Kess, with all the crypto action?
Yeah, crypto is interesting to me. I'm not really a huge crypto guy, but the one thing you have to remember with crypto is it abides to a lot of technical analysis, a lot more than it would to like normal stocks do, which is nice, and it helps to make it a little more predictable and easier to play in some sense. So with your whole idea of the patterns and repeating and Groundhog Day, I could totally see that happening. Investors and traders are very psychologically driven people. So we see patterns forming over and over again, and we play those patterns over and over again. Hence bull flags, bear flags, supports, resistances. Like it's all psychological supply and demand. So when we come to like these monumental days and events such as the short squeeze events that happened in January, and the crypto rally that happened at the end of January, you have to kind of think about these people that played it last time are also thinking the same thing. It happened last year. Why can't it happen again this year? So that creates an extra amount of demand where it wouldn't usually be without the previous history, the previous patterning.
I agree. And again, even if they decide to keep pushing it down, like you're playing in the same psychological level no matter what. I think our generation, and especially, I think technically Kess is the same generation as me, but those younger investors, like they don't understand how far down things can go. So if things do decide to go down, you might not necessarily see the rush of panic sellers to the same degree as like an older, like probably like Zach might be a better example. Zach Trades, where he's kind of lived the other crashes. If I think it might be a slower decline because it'll be more likely for younger investors to hold on to their positions rather than just sell them right away, which might kind of ease the decline into crypto or ease the decline into any type of stock. Like especially even the memes, like you would think they'd all be done by now, but people held on. So you think like the cryptos would. I don't think that people are necessarily going to panic sell their way out, but you see these huge, large scale investors in crypto like liquidating what 175 million or something or billion yesterday that caused that push down. But I'm not sure necessarily if like your average crypto investor really has that much stake in the game. But I think there is a large scale crypto investor. So it's kind of the retail mindset of where there's a bunch of retail with a little bit, which adds up to a lot of it. And it's the same thing where like the hedge funds and stuff pay attention to Twitter because the sum of the collective is enough to matter to a scale. But I think it could be taken advantage of. I think the lack of awareness of people into what could happen, I think could get taken advantage of.
Yeah, no, I totally agree with that.
Um, so what's your pick for 2022, Kess? You think if you get down low enough, what stock would you want to add?
There's a few. I'm kind of focused on, with supply chain issues. I'm eventually those will all be resolved, and in order for those to be resolved, there needs to be some sort of like organization within these corporate companies and stuff like that. And like Microsoft offers these group meeting the programs and software and stuff like that. So along the lines of like some sort of management software is kind of where I'm leaning towards, only because at the end of the day, supply chain issues won't last forever. So the companies that are going to be able to help these larger companies get out of this supply chain issue will be the ones that will succeed the most. I think there's Asana, Team, like I said, Microsoft. Those are all top contenders. I think in that kind of sort of sector that I have my eyes on. And I mentioned a little while back last year, Asana is kind of one of my speculative, I guess, but top picks for that kind of sector, just because of the risk to reward value from where it's at right now.
Right.
But just kind of that idea of kind of still bouncing back from this whole COVID disaster and figuring out ways to make sure this economy can start running smoothly again with supply chain issues. Um, maybe even oil, oil and gas and stuff like that, stocks like that might start to see some sort of sympathy, and because there's supply chain issues there. So it all comes down to who's really putting in that extra work as companies and corporate companies that are willing to kind of build their company back up from where they were, because the stock price doesn't always mean that the company's back to 100% from where it was before COVID. It's just buyer sentiment and supply and demand. So we have to kind of pay attention to is what these companies are doing fundamentally, that it will help them in the long run after what happened, in 2020.
Yep, I agree. And then it's good how see how Kess kind of has his plan of what he thinks is going to happen and what stocks he's looking for. So during the bear market, or not even that we're in one yet, but the sell off that happens, it's good to have a list of names and then think of 2 or 3 reasons on why you think that company is going to be successful, and then use that same methodology, like Kess said, like the supply and demand. So look for spots where, hey, this is where it was before a breakout, or hey, this is where it was before some news came out, and kind of start to whittle your list down to stocks you like, and then take some shots with stocks. You can take some shots with options, but kind of have your core list. I'm interested. I like if Snowflake ever made it back down to the mid 200s, I would love to take some more comments in that area, just because I think long term the cloud computing and that software is going to be regular. I think it's just going to be a necessary point for business.
I agree.
Yeah, same with Palantir. The problem with Palantir is everybody likes Palantir, so you got to shake loose the bag holders before they're gonna make that run up. If everyone knows something, it never ever happens. And that's like when me and Kessel put the tinfoil hats on in our group chat and go, everyone knows this. It's not going to work anymore. This person's talking about this. Obviously, it's not going to work anymore. And there is some joking to that, but once things kind of get commonly known or the same common idea, it's very, very hard for them. You have to have that feeling of maximum fear, hopelessness, for things to start to go back up. And I think there might just be a little bit too much euphoria around Palantir still. I think if it got taken down to the low teens, or even 12, I would probably take a pretty heavy position there if I could get Palantir around 12, just because I think the cloud is going to be real. Even if the world goes back to pre-COVID, where we're fully in the office all the time, or fully working in buildings and no remote work, the cloud, they're not going to remove that data. The data is only going to get more and more important. That's why you always see Facebook getting into scandals about oh, they were selling this data, or people were farming this data. Oh, here, Composite Dave sent me a message. That's the Composite Man you're talking about. That's right, the Composite Man. You want to talk about the Composite Man, Dave? But like he said, you got to be kind of on the edge of something. You gotta believe when other people quit believing, and that's kind of why I like dip buying and stuff. Is you always want to buy when something looks disgusting, and then sell when it looks beautiful. Once it's at the top, maximum euphoria. You don't want to be buying when everyone's like, this is the greatest thing I've ever seen. You want to be buying when they're like, I don't know, this might be the end here.
Yeah, no, and that's definitely a different kind of approach that a lot of people, especially on Twitter, have kind of gotten away from, only because of the recent momentum in the market. You have easy momentum trades, but now you kind of have to start strategizing more, and finding your spots to enter, instead of we break a level and it'll continue, because sometimes we're seeing a lot of fake outs recently. So it's you have to start kind of going back to the basic ideals of buy low, sell high, and buy as low as you possibly can and sell as high as you possibly can. It might not be perfect every time, but when you're buying these ugly looks and selling pretty, then you're really they're just that much more ahead of the game than people that are trying to buy the break of so for example, say you buy AMD at 100, and when it dips down to 100, and somebody buys AMD as it breaks out at 125, you're already up 25%, while that person is just entering their position. So you have to kind of decipher which trades are more appropriate for momentum, and which are more appropriate for dip buying, which takes time, skill, practice. But over time it will start to show itself to be a lot easier to kind of understand and present itself, I guess.
Yeah, and that's one of those things where you got to understand what market you're in. So that's why I was cautious to swing things. I was like, if you're not going to get that continuation of the move, like Kess, like I'll like for the AMD example, if I'm buying the 100, let's say I buy some options and it goes to 125, you'll also get those momentum buyers pushing your price up with you. So when they get to 50, you might be at 150 or 200 because there's more buyers stepping in because they also want it because it's breaking out. But when markets are in like long-term consolidation, or if they're in like a bear market where they're popping up then just selling back off, you don't necessarily want to be in a position where you're holding for like the maximum gains or the longest output. It's kind of one of those where you got to adapt and see, are you getting those 1 or 2 or 3 day runs, or is it just like popping for a few hours and then selling right back off? So that's why I'm not comfortable really swinging anything yet. Or you want to feel it out. You don't have to put your money in there every single day. I saw someone said like, oh, inflation, your money be worth less tomorrow. Well, it'll be worth a lot less if you put all your cash into something and it goes down another 10% because you put it into growth stock too early, another 20% because it went in too early. Because that was the same thing that happened even to those like AMC. I made a joke like, oh, back to levels not last seen since Tuesday, because it just knifed straight down. So you need to make sure that you have a reason to get in something and then you have a plan getting out. And when you don't know necessarily conditions of the market and you're playing those levels, like Kess said, like you might want to not look at a weekly. You might want to take even like monthly positions will have a lot of volume in them, so they're less likely to kind of pop and drop as fast. They're more dependent on the full move happening. So if you're like, hey, I want to start stepping my way into something, maybe take a monthly option. And then the monthly option, you won't get as big of a percent gain, but you'll have more of a secured position for when that jump happens. I guess. Anything else you want to touch on, Kess? I know it's Friday. Everyone wants to be out doing something. But I thought it was kind of a good thing to review kind of where we think the market's good. Bull market, bear market, or chop market.
Yeah, definitely. If I were to give it a name right now, definitely chop market. Like if you just throw on SPY Weekly, you see this 470 level was such a tank of a wall to get above, and we get above it for 1 week and fail and come back down. So right away, that alone kind of raises some red flags for me as to smaller position sizing and be a little more cautious on what to dip by and what momentum plays to take. So that is kind of where I'm at right now, is a little bit of in between until some more direction is decided. But yeah, that failed breakout at 470 on that weekly is not ideal. So we'll see what happens from here. As of right now, like I said, I'm more focused on this market's going to be chopped. So smaller position sizing, more cautious entering, better timing on everything. So yeah, that's where I'm at
Yeah,
least.
I think that's the big thing too. Is especially, I would say, especially for everyone, just reduce your size a little bit for these next couple of weeks until it gets more clear. Like if you're in a bear market, I mean, I assume most of us here are options traders. Instead of buying calls, you just buy puts, and it works the same way. So you're like, oh, nonstop uppies, it's just nonstop downies. It works the same. It's just a different direction. But when the trend of the whole market, like you can look back, if you zoom out a year and look at SPY, you can see it's just this nice uptrend the whole way through. Well, the same can be true where it's a downtrend and you just do the same thing. You're like, anytime a stock pops up real high, you just buy a put, assume it goes back down to a previous support level, and then right around that support level, walk your way out because it might bounce back up. So that's the advantage of being in cash and then being able to walk in options. So if I see like on Monday, everything's shooting down again, like SPY's tanking, I could probably start to make the determination that, hey, we might be leaning towards a bear market or a downtrend year just because of rates. Like you can't sit in a zero rate market forever. I know in Europe they have like negative rates, but long term that's just going to cause issues. So I think it's the right move to raise rates, but obviously short term the market is going to not like that action. So if we keep that downtrend, it's better to have a bear market or a bull market, but like Kess said, the consolidation chop zone market, that's really just bad for everybody because all you're going to be doing is giving your premium away to the market makers every week, and there's not really going to be a lot of money to be made like week to week, month to month for options traders. It's going to be more of almost like a lost year. You're just going to be there kind of catching these little moves, but it's going to be really difficult for those breakouts to happen.
Yeah, I agree.
Yeah. And then I guess with that, I mean, you got anything else to add, Kess? I think this was a pretty good little powwow session. It was nice to meet and talk to you finally.
Yeah, absolutely. I think we covered pretty much everything that is important enough at this time and point.
Yeah, Bills cover this week.
Yes, money line.
Money line, they're like minus 16. Fade
Book
the
it.
Bills.
Just book it. Just book it.
Book it. All right, the last piece of advice is money line Bills. All right, Kess. Well, you have fun at the beach, and thanks everybody for coming and hanging out with us. And we'll have to do this again sometime, Kess.
Absolutely, absolutely. Thanks everybody for coming. Thanks, John, for having me. It was a great time. Hopefully,
Yep,
everybody learned a thing or two.
of course. All right, later.